Hi, everyone. Welcome to lesson 9.2 of Elite Youth Business Academy, Pro Forma Financial Statements. My name is Guhan,
And I'm Soham.
and let's get into it. So, we're first going to talk about what a cash flow statement is. We're going to move on to an income statement, and lastly, talk about a balance sheet. So, now I'm handing off to Soham.
So you may be asking, what is a cash flow statement? This is basically an accounting report meant to describe the way cash flows in and out of a business over a period of time to basically describe what a business is doing and predict the trend of business. This includes forecast receipts and disbursements, which is meant to estimate the cash receipts, and then cash receipts, which are like the cash sales plus collected loans, etc. And then there's cash disbursements, which is payments for the cost of goods. Well, like basically what you pay to manufacturers plus taxes, etc. Then the steps to make a cash flow statement is basically to prepare, which is done for the first, second, and third years to provide an estimate of cash flow over time. Then there's also net cash flow, which is cash receipts, which is income minus cash disbursements, expenses, which is equal to the net cash flow.
So, first talking about what an income statement is, it shows the business's revenues and expenses over a period of time and the resulting profit or loss that the business gets. It helps examine sales, expenses, and income. It can help businesses forecast for the future while analyzing costs and identifying categories of expenditures. Most importantly, it shows revenues that you have not yet received or expenses not paid yet, so you know what to keep in mind in the upcoming months. And now, a balance sheet is a financial statement that lists what a business owns, what it owes, and how much it is worth at a particular point in time. The assets that it has includes the liabilities plus the owner's equity. And the type of assets can be categorized into current assets, which are things like cash and inventory, or things that you can liquidify really quickly, accounts receivable, which are amounts owed to the company, and fixed assets, so things like buildings, furnitures, computers, or things that are more difficult to sell.
So there's two types of liabilities. One is long term, which is payable over a year or longer, which is kind of like mortgage. Then there's current liabilities, which are debts that must be paid in less than a year, which examples could be accounts payable, which is amounts owed to vendors for things purchased on credit. And then there's also reductions in asset value, where there's an allowance for uncollectible items where some customers may not pay. Like, for example, they die, they like physically or like literally cannot pay, and then they must be accounted for. That must be accounted for on the balance sheet. And there's also depreciation, which is a loss in values in items value over time. Basically, you buy a computer, a fixed asset for 300, and it decreases to in value to $50 10 years later when there's more newer tech or like newer computers out there for people to use.
And now moving on to the joke of the day. What's a criminal's most important asset?
I don't know what is it.
Their liability.
Ah, ha,
Ha
ha, ha,
ha
ha,
ha
ha, ha,
ha
ha.
ha.
Very funny, Gohan.
Thank you guys so much for watching today, and we'll see you guys in the next one.